Hello and welcome to another edition of the Crypto Club and Digital Assets Weekly Catch-Up on Zoom. It is Sunday the 24th of November 2024, and it really is this time because I got the date stamp wrong last week. And this week we're going to be talking about whatever we end up talking about. Sometimes we discuss crypto, blockchain, DeFi, NFTs, ICOs, STOs, TGs, all sorts of three-letter acronyms really. We sometimes delve into the mystery of central bank digital currencies or CBDCs, regulations, stable coins, so much more. So stick around. Hopefully there'll be something in this session for you to enjoy. If you do like it, do remember to click on the subscribe, the like, make comments, or even better, come along to a future session. We hold these every Sunday evening, 7 p.m. till 8 p.m. UK time, and everyone's welcome, novice and expert alike. So if you'd like to ask some really basic questions, or you'd like to talk about your project and what you're working on, come along and join us. So with that, let's see who's going to come and join us today. Hello, Hector. No, Mike. That's a great start. Going to be a challenge speaking with you. Do interact via the chat there. That's not a problem. Hey, Gabriella.
Hello.
Good evening to you.
Good evening to you as well, and to you.
Are you here for another exciting week of who knows what we're going to end up talking about?
Something positive.
I can't even remember what we were all talking about last week.
Where we speak about a lot of topics, I think, about different.
I know we've been talking about regulation around the world and the metaverse and the impact of technology. So
Yes, I think that the regulation around the world, I think, is the main topic, Gary, right now.
Yeah. And there's still lots more coming through with the regulation. And it's going to be interesting as well now with the US elections over with, in what the new presidents and new entourage or whatever, what they're going to do regulatory wise, because there have been claims that they're going to be quite crypto friendly, which could be really exciting because that might encourage other countries to be a little bit more regulatory friendly with crypto. So that's good news. We'll see where that goes. Hector, do you want to try and type in where you're calling in from today and where your interest is, and we'll try and involve you in the conversation as well. And we've got JT's just joined as well. Hey JT, welcome aboard.
Hey.
Long time no speak.
Yeah, busy.
You're always a busy man, so it's always good to see that you find time to join us on this. That's great.
Yeah. Today just finished a call with someone again, trying to create a pump.fun.
Okay. Oh yeah, because we're talking about pump.fun. Was that last week or the week before?
I've been for 3 or 4 weeks. I've been traveling, so I don't.
Okay. Yeah, I seem to remember we were having a conversation. Maybe it wasn't you that was leading it, but I thought you were involved in some way, about the platform pump.fun, which I'll just share now, which is the ability to effectively spin up a token, isn't it?
Meme coin is a meme coin launcher.
Yeah.
So
yeah. Go ahead.
Yeah, that's pretty much what it is. You just create a meme coin, upload. You can actually try it yourself, just start new and connect a wallet, I think, first. Yeah.
Okay.
You basically just put an image, the name of the meme coin, the ticker, a description. That's it. The supply, and then that's it.
Okay.
People start to buy it as soon as it reaches the bonding curve. When the bonding curve reaches 100%, you can see that on your right side. Just click on one of them.
Okay. Yeah, let's find something of interest about this.
Doesn't matter. You see there exactly it says bonding curve on the right side.
Okay.
Can you see?
Yeah, I've just got something over the screen at the moment.
Just below the.
I've got the buy sell.
No, down. You will see progress.
Bonding curve progress. Yeah.
As people are buying, the token, then the bonding curve. I don't need to explain what bonding curve is, but as soon as it reaches the bonding curve, you will launch the meme coin automatically with that liquidity. Yeah.
Okay.
And it launches on Radeon, which is the DEX on Solana. So this is runs pretty much on Solana. Yeah,
Okay. Wow.
yeah.
So
So
effectively, when there's enough people to put up a market of buyers and sellers, that's when it hits the point where it kicks off. Then is that right?
yeah, pretty much bonding curve is a relationship between price and the supply. Yeah.
Okay.
So
Just seeing if there's anything that's actually live or whatever where we can see anything in action. Market cap $7,000. That's just brilliant. As you say, it shows how you can have a really small cap markets
yeah,
coming up.
there's lots and lots, and then soon many they will never leave the pub.fun because they don't reach the bonding curve. Yeah,
Okay.
100% of the bonding curve. So they always stay there, and then people trade even there. They buy and they sell, and they keep making money. One Solana here, one Solana
Okay.
there. So there's people do that as a job on a daily basis. Lots of traders of meme coins are doing that stuff now.
Wow.
Yes. Majority loses money. Okay.
Okay.
So that's the
Well, that's
principle.
normal.
Yeah.
Yep.
And there's people who have also bots. They
Okay.
have Telegram bots all configured to actually buy every single coin that is launched there. For example, there was a guy who was telling me that he was one of his friends was putting something like 0.01 of Solana on every single coin that is launched,
Okay.
and then just waited for other people to buy, and the bot he'll configure the bot to sell at 2 or 3x that he made. So he's saying he was in the beginning. This was like back in March, April, I think. When Pump.fun became quite crazy. And he said it was a friend of his who was making like $50,000 to $100,000 a day just doing that with a bot. Like
Wow. Yeah.
you know.
It's
So
just
now, of course, it kind of became commoditized, and there's other copies. You can go to another one called gra.fun, gra.fun. So that one was the guys from DWF. DWF is a hedge fund slash market maker.
okay.
They've created that on Binance chain on BSC, yeah, or
Okay.
BNB chain now, yeah. So yeah, that's the one. So this is the one that runs on.
So this runs on Binance, whereas the other one's
Yes,
running on
on
Solana.
Binance Chain. The other one runs on Solana. I think these guys, I spoke with the founder of these, yeah, and in Singapore, I think they have plans to integrate on multiple chains. So let's see. It's a brand new world of meme coins. So
Yeah. Yeah. Seems to be the latest hype. Where we go through there's many hype waves within the crypto space, and meme coins definitely seem to be one right now. So okay, thanks for sharing that. So gra.fun. So some things to check out later on. That's good. Excellent. Thanks for that. Okay. Hector was just saying he's joined in, but he's not got a microphone today. But he's watching from London. Experience in equities, news crypto, want to learn what to look for in a coin. Well, that's really, really interesting. I guess most people in crypto are looking for something that's going to go up in value. The problem is we don't really know what or how with a lot of things. So there's a lot of people who have opinions, and it's something where I'll defer from offering an opinion around particular cryptocurrencies because I don't make financial recommendations. Um, I've heard it said for many years with investing in crypto that what you should do is do the research, read the white papers, look at the project, look at the team, blah, 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 blah. The reality is that sometimes makes a difference. And sometimes it's just that the market decides to grab a token or a crypto or a meme coin or whatever, and they hype it up and they make lots of money on it. So, Hector, it's there are so many views on what you should look for in a coin. Um, for me, resilience is an important one. So Bitcoin is the longest lasting cryptocurrency. Ethereum's been around for a while. Since was it 2014? I think it launched, or 2013, so over 10 years. They tend to be more durable. So I would avoid any of these meme coins, which we've just been looking at. You just don't know what's going to happen to them, that they are pure play gambles. And just be cautious and just learn. More importantly, beyond any particular coin that you're looking at, just learn how to create a wallet, register with an exchange, and actually have a go at buying, selling, or transferring some crypto. It's not easy to begin with, but it gets easier and easier with practice. So there's a few thoughts and suggestions. We're joined by Annie as well. Hey, Annie.
Hello.
Hey.
Good evening.
Hey, good evening. Whereabouts are you based, Annie?
Cambridge.
Cambridge, okay. Cambridge, England, I presume.
Yes.
Not the Massachusetts one. Okay.
No.
Yeah. The nice flat countryside one. That's fair enough. Excellent. Well, welcome aboard. We're just chatting about all sorts of things right now. I don't think you've been on one of these sessions before, have you, Annie?
No, this is the first time for me.
Okay. Excellent. Well, welcome aboard. What brings you along today? Anything particularly of interest?
I'm kind of curious as to how war around the world is affecting cryptocurrency, or there is no effect whatsoever.
Okay. I'll offer a view that war, as in you mean conflict.
Yes, as in, and then, there's a lot of things being hyped up about World War III and all that sort of stuff. So,
yeah, I guess I'll offer a view, and then anyone else can join in and come in on this as well. That conflict tends to lead to uncertainty as people worry about what's going on. There are always wars happening around the world. I work a lot in the insurance industry, and we do a lot of insurance policies around war and terrorism, and political violence and conflict and all this kind of thing. There's always wars going on. It's not until they become quite close to your own geography that you kind of start noticing them. So there's always conflicts going on somewhere. But if I share with you briefly, there's a thing called the fear and greed index. And this kind of relates in some way to how war might affect crypto. Because ultimately, the more uncertainty there is in the world, and war's a great creator of uncertainty, then the more conflict there is, the more uncertainty there is, the more fear there is about how worried people are and this kind of thing. And you can actually track fear and uncertainty on social media. You can look at comments that are being made on social media streams or mainstream media and that. And this is what CMC, so that's CoinMarketCap, they track what they call the crypto fear and greed index. So this is more specifically about the greed aspect of crypto. And what you tend to find is that when people are fearful about things to worry about, that tends to be when crypto does quite well, because it's thought of as kind of a hedge. So the old argument used to be, if you think about the different types of investment that there are, whether that's shares, property, gold, or precious metals or whatever, tends to be that gold is a safe harbor when things are going badly. The whole idea being, well, if there's going to be a conflict, I'll invest in gold and it'll go up in value. Crypto is kind of viewed as a similar thing to that. But I don't know, anyone else on the call who's got a counter view on that?
Yeah, I have a counter here, as always.
Yeah, good.
Look, my view is at the moment things are very, very different because AI bots have become, trading bots have become a little bit more sophisticated. I don't like to use the word clever or intelligent because they're not. They're just sophisticated. And before, they used to react to any type of news, and they would just go and sell very quickly or close positions or whatever. Yeah. They become a bit more sophisticated, and they don't react very quickly to anything around wars, unless if there's something really, really bad. Let's say, hopefully not. Yeah, nobody wants this. So let's say you know, a nuke is launched on some country. Yeah.
Mhm.
That's bad. That will kind of crash all the markets. Okay. No doubt. Just the prospect of people talking and being on the news, the bots became sophisticated. They do not react. So people do not react. Crypto traders do not react anymore to all of that stuff because they know there's a game play as well there. So I know it balances out. So why greed is there? It's because it's how the cycle starts, you know. So the cycle, oh, the Bitcoin cycle starts with a halving, okay, and then it is the year at the end of the year towards November. Usually it's between 14 to 21st. This time was 1 week before. Yeah, it starts really to go up. Now this time it went up very, very fast because institutional players got with ETFs earlier in the year. You know, things have changed dramatically, so it went, of course, a lot faster. And of course, that drives greed. Yeah, everybody becomes greedy, and then the people who didn't enter first because they do not understand a lot of the mechanics around crypto. You know, they didn't enter at late towards the beginning of the fourth quarter of 2023. You know, then they're going to enter early in 2024. It happened, and now everybody's coming in. You know, because everybody sees the crypto going really fast, and all the people, the latecomers, will start to join, and that's when the greed index really goes to the top, you know, and that's not healthy, not healthy at all for Bitcoin, you know. What the past have shown to us is that wars do not have impact on that. It's like you said, there's wars every day, but when it comes close to us, you know, it's only if something tragic now happens, then there will be some big impact on anything related to crypto trading, you know.
And it's interesting as well, we were talking about like the fear and greed index, that's not a crypto particular thing. There is an index that exists. Yeah, I've got one up here for at the moment, which is around the traditional stock markets. This is the US stock market.
It's not there yet, you see, 61 only. That's how, that's
so that's quite low compared to the crypto world, which is 80 something.
When it goes to extreme, usually there's a big correction, you know, massive correction, but we don't know if that's going to happen because if tomorrow Microsoft comes and the board, apparently they were in conversations this week, and if they approve, then Microsoft could actually put 20 billion of that treasury, for example. I'm just throwing a number. I don't even know, you know.
Yeah.
Then it changes completely, you know. There's not going to be correction. It continues, the greed continues to stay there, you know. But the longer that stays there at extreme, you know. So the way to make money in crypto, I heard this long time ago at a conference, was 2017, if I'm not mistaken. I think it was in Malta even. Yeah, that a guy was on stage, and I can't remember who the guy was, you know, but he was saying, the way I make money in crypto is very simple. When there's extreme greed, I sell. Yeah. When it's really at the bottom is when I buy. It's the only way to make money in crypto, you know. If it goes above the 50%, you're already too late to make money. You are actually getting a massive risk in doing that. So since then, you know, I've always thought like this guy, you know, you have to really be at the bottom to be able to do it.
Yeah, it's one of those things that if we were all good at being able to predict future prices, then we'd all be retired or relaxing on a beach somewhere. So, Annie, to come back to your point really about, you know, how war affects the price of crypto, it may have some influence, as JT says. You know, it may well be with the bots these days that it's having less of an influence. But I would certainly argue that if people are thinking of crypto as an alternative reserve asset class that hedges against a really bad situation, then wars tend to generate an increase in the prices of crypto. Well, I don't know what's your thinking,
I mean, yes, it's when it happens actually is when it drives massively to people to those safe havens. Yeah. in general, massive, now the more traditional investors, they are insiders. They understand when something about to happen, or they have certain type of intelligence that other people don't have, then they will come early into those safe haven assets. There's nothing as such, but you know what I mean, yeah, gold or whatever. Now the rest of the people is driven by when it actually happens. Then everybody wants to go safe, and it's a rush. And of course, people are becoming more clever now. People read more. Everybody has a phone and internet. They read, and they understand it's always better to start to hedge early. As you see things happening. But usually, the massive driver to certain type of assets is when something bad really happened. Look what happened, for example. Coronavirus was a bit an exception, but on the day that the lockdown was announced, do you remember what happened? All the markets died massively, absolutely massively, So I remember Bitcoin went to $3,400. Yeah, went from 10,000 to 3,400 or 3,700. I can't remember. Yeah, 3,700. Yeah. But then everybody thought, wow, this is going to be bad. Yeah. And everybody started to put money back on Bitcoin, on gold, and so on, So you always see that big dip when something bad happened, and then everybody starts to come to those and hedge.
Annie, what's your thinking?
Yeah, I'm what I've learned from just Gary and JT here is that it seems to me that I think what you're saying is that those who are very mindful of when it's low, probably they invested when it suddenly come really low down at the point of lockdown, and then now, because it gets into the greed section, means that the price has gone up high. So potentially these people would probably sell it because they purchase it at the point of low when it was in COVID time. Now to buy now, that is the wrong thing to do because it's now already very high because everybody is trying to come into it. I think that is my understanding from what you
equally. Whenever I used to hold these sessions in person, I would always get people who'd be asking pretty similar questions. When is a good time to buy? When is a good time to sell, and so on. And I always said that the only people who you should really listen to are those who've made a lot of money doing what they're now talking about. And the only way to prove that, I used to say there's 3 tests. And if someone can't pass through these 3 tests, then don't listen to them. The first is that as a result of the crypto trading, they own their own yacht. Okay. Wow. So if they got their own yacht and they've made money out of crypto to make that's one test. Second test is that they've got to own their own private jet. And the third is that they've got to own their own private island. If they don't own those 3 things, then they might be quite good at crypto, but not necessarily consistent. So the first thing is I don't own any of those 3 things, so you shouldn't listen to me anyway. But most people are actually not very good at predicting, when to buy, when to sell, blah, blah, blah. You'll find that it's true in traditional markets as well. So, Hector's got an equities background. I'm sure he'll bear this out. Most people who've got like Charles Schwab accounts or whatever the traditional investment companies accounts are these days, where you're buying and selling shares. Most companies will tell you that their customers lose money. I think I went to an IG index event, I think it was, and they said 80 to 85% of their customers lose money in buying and selling shares. It's just that the 80 to 85% of people think they're about to be the 15% who do win. So most people get it wrong. If you look at the people who most of us pay in order to get financial advice, so like hedge fund managers or pension managers and that kind of thing, even they don't do particularly well in terms of predicting things. They might be able to come up with safe, stable things about, The Asian market's nice and steady and it's growing, blah, blah, blah. But all of them get it wrong at times. And that's what kind of frustrated me for many years, that, you might have a pension or an investment plan and you're paying someone to manage it and you're paying someone for their advice, and you get them coming up saying, really good news. Your fund only lost 5% this year, but that's much better than the rest of the market. It's like, you got to be kidding me. So, Annie, the reality is no one really knows. The ones who do know are the ones who don't necessarily trade, but provide the services for others to trade. So it's like the old joke about gambling. The only real winners in gambling are the bookmakers who play the odds and the casinos. The casino doesn't care if you win or lose because they make their bit anyway.
Yeah, exactly. I mean, I think this is quite a good application for pension as well, because I think what has happened was during the COVID time, I think I have done the wrong thing, in the sense that I changed some of the pension funds to something that is higher, but then the trouble was they were already higher before I changed it there. And then I think it kind of lost money for 2 years before it come back up to where it was. I was thinking, really? So by changing the funds meant that I actually has lost the capability of being able to gain more interest for 2 years in a row. I thought that is not a good thing. And as you say, it's nearly like impossible for anyone to be able to give proper financial advice anyway. I think the other important, interesting point that I've listened to JT so far is about AI. Do you really think AI is doing a good job with getting, real thing that if people follow what the AI is doing, is actually gaining something?
JT, do you want to join in on that? Is the AI working?
Yeah. What was the question? Sorry, I missed it.
Go ask again, Annie.
Yeah, that's fine. That's fine. Well, you were mentioning about AI earlier, JT. I'm kind of curious as to whether AI actually is very accurate in its predictions, or has someone actually tried to follow it and managed to get something out of it? Is it actually better than the financial advisor? I think that is probably, or whoever that is, the broker for shares or whatever.
Yeah, look, I haven't seen any good AI out there. These are just bots. A bot is not an AI. Yeah. So a bot basically buys and sells based on certain criteria, clearly defined functions, and it just does it based on data that is receiving constantly, from all different type of sources, including news, etc. And then depends really at the what is the impact of certain type of news, impact of certain type of things happening in the market that leads to the decision to buy or sell. Yeah. So this is the trick then, whoever has the most sophisticated bots are the ones who always make more money. So there's continuous war out there for people trying to build better and better bots. When you're going to have AI, I was in Singapore in September at Token 2049, and I don't know if I mentioned this here before, Gary, but there was this guy who was showing me his app that he put on his Android phone. It's still in development, but he already had, I think he said 30,000 users that he onboarded just to test. And literally, he had only a slider, green to red. So it was basically a crypto bot. He was building more into an AI than actually a bot, but there was the trading bot part of it as well, where he was training an LLM to be able to actually make decisions based on what people were using on the slider. So you make actually quite simple for the user. If it was green, if the user select the slider to the green side, you basically put your stable coins, it will stake it to get 8 to 10% interest, So basic stuff, no risk. It was green, but if you slide it right to the red, to the other end, then the so-called AI, he was calling it an AI, yeah, would become a meme coin degen investor, you know? So he's just buying and selling meme coins and was quite high risky, you know? So this was what he was testing. And I think anyone who will be able to manage to crack this. I would personally not put a bot like that available for everyone, because then everyone is canceling each other out, you know. There's no winners here. There's only a little bit of passive here, winning here or there, you know. And yes, if you have no risk, then of course, you know, it's safe investment, nothing else. But you can do that without having such type of app with an AI. So the AI part, you know, is what's going to be interesting here, and nobody has that answer. I don't think the AI will be able to, on its own, to be successful, because there's always other people creating other AIs, and they will continuously be. It's very hard then which AI you're going to trust, yeah? Which one is going to do better for you? It's
that's probably the thing that's worth picking up on as well. That first of all, it depends what we mean by AI. So exactly as JT says, you know, a trading bot might be something that simply got a buying and selling algorithm in it that says, you know, if price goes up by more than this amount over this period, then buy. If price goes down by more than this amount over a period, then sell. You know, it could be something as rudimentary as that. Or it could be something that is looking at social media, is doing sentiment analytics. So it's seeing, you know, people are making comments on Twitter about something, people are making comments on LinkedIn about something, or WhatsApp or whatever. And so you get some platforms like Crypto Hopper is one I know of. No, I'm not recommending it or dissing it or anything, but that's where you can plug that into multiple sources of information, and you can use that to start training to say, when you get this piece of information, then, you know, buy, sell, or whatever. There's a real variety. A lot of the AI type stuff I've seen up till now is simply algorithmic estimation of potential future prices. And it's just looking at the market and it's saying, well, this is where it could go. There's an 85% probability it's going to go down. There's 15% probability it's going to go up. Therefore, short stock or whatever. And that remains true with crypto and with traditional stocks. I've also seen a number of companies, and they seem to have died away, where you get people who've come from the traditional investing community, you know, whether they're stock traders or investors, whatever, and they've had algorithms that have worked for buying and selling shares. So it's done the whole, you know, if it crosses over the 200 moving day average and blah, 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 blah. And they've tried to lift and shift those algorithms into the crypto world. And I think there was one quite well-known one in the UK about 5 years ago that tried that, and they went bust, because crypto does not behave in the same way as stocks and shares do. You know, shares ultimately are backed by underlying physical assets of a company, with customers, with suppliers, with product, with everything. It's generally relatively predictable, that kind of thing. Whereas crypto is based on nothing fundamentally, and so tends to be a lot more volatile and can become illiquid very quickly as well. You know, I used to laugh that the best way of finding out that the markets were getting active and worth watching was when I started getting messages off friends saying, "Oh, Binance has stopped people from trading," or "Coin market's not letting anyone trade at the moment." So crypto just behaves differently because it doesn't have an underlying asset or an underlying product, customer, market, or whatever type thing. So it's always interesting watching people who've come from the traditional world trying to apply the model in the crypto world. And, you know, Hector was asking before, he stuck a note in the comments to say, you know, for equities, the intelligent investor is widely considered as the Bible. Is there an equivalent book person website for crypto? In terms of investing, or speculating or trading or whatever. There's a whole variety. The people I would recommend are the ones who don't shout. So if you go onto YouTube, there are a few crypto experts in inverted commas who are constantly shouting, and I would say ignore those straight away. If you want to know a little bit about the theory, then the likes of Andreas Antonopoulos, who is an absolute luminary in this space, who has written and produced a lot of stuff, including books, around how cryptocurrencies work and how blockchains work and that. I can always recommend anything by Andreas Antonopoulos. Very intelligent guy, really knows the stuff, but he's not a trader as such. Whereas you get some of the traders, I'm not going to mention any of the names, but check them out, and you'll find there are some people. But ultimately, and this links in with kind of Hector's question and Annie's really, what you need to do is to be able to back test whatever these people are saying or whatever these algos are saying. So you can quite often take an algorithm and build a model with it for like price prediction and buying and selling, and then get back history and apply the back history to see how well it does. Quite often it doesn't do very well. Try the same with these crypto experts. So people who are on YouTube channels, this kind of thing. Go and take a look at through some of their previous talks, see what they predict, and then see if it happened or not. Because I think you'll find an awful lot of the time it doesn't. And what you tend to find is that the people who shout, the ones I was mentioning a minute ago, tend to be very good at pulling up a chart. And we can do this here. If I grab a Bitcoin chart or something, and that they'll talk you through it. And I've been to events which are like this, and they'll say, "Well, hey, here's this Bitcoin chart at the moment, and we can see here that there was an event here where the floor was obviously at 91,824, and there was a peak of 98,593, and when it broke out of that, it was obviously going to go up, and here you go, sure enough, it rocketed up, and then we can see the same here when there was a new floor set up and so on." And you hear them, and they're very, very good at explaining the past. So they can always say, "Oh yeah, this is a good example of like a rising dojo, whatever," and they always use these patterns and that of what's already happened. What they don't do is they don't do something like get a real-time chart like this and say, right, okay, see where this has just done this particular movement now. What that means is the price is currently 96 to 80 or whatever. This means it's definitely going to go up. So place an order now. And as you can see, actually it did the opposite. It went down, that kind of thing. So I'm never convinced by anybody who's doing those kind of presentations. So Annie, I don't know if that was helpful or useful.
Yes, it is. It is very helpful. I was wondering the area that we are covering now, whether it actually cover what Jeremy do, because from my understanding of what he normally do, but I don't think he's in the call. That we probably cover what he's very good at. He told me that he does predictions for shares, and I said, how do you do it? Is it better than the London Stock Exchange? And he said, yes, he could do it better than London Stock Exchange. I was like, oh yeah, okay.
Yep.
So yeah.
The thing is that there's a lot of mathematics and computation going into future predictions, and that's been the case for many years. I used to work in commodities trading, and we had what used to be called quants. In fact, they still are. So quantitative analysts. So these are very highly paid mathematicians who were doing prediction models on future prices of, in our case, commodities. So like oil, metals, energy, that kind of thing. But you can do the same with share trading. And you build up your models and you do them for predictions. there is a lot of maths behind that. And if you are willing to invest the money, and it's massive sums of money, into high quality quant traders, then you can make a lot of money. But for most retail people, you just go on the piggy tails, which is why what some people do is they'll either buy a tool that helps them make predictions, which is the area like Jeremy gets involved in, or they simply take out like an eToro account or something, and they do what's called, I think it's called mirror trading or shadow trading, which is where the likes of eToro, and I'm sure it happens on other platforms as well, there are certain people who are known traders in that particular area, and you basically say, I want my account to replicate what they're doing. So when they buy a particular share or a crypto, then your account buys, and when they sell, they sell. So you're basically following what they're doing, which means that you can do quite well out of their trading activity without having a clue what's going on. So it means you're not learning anything, but you can be making money, which can be good. But there's no guarantee that anyone who's a top trader at the moment will be a top trader next week. So a bit like, as Annie was saying earlier on, how, when an event happens, whether it's lockdowns or anything else, and you suddenly think, oh, I'm going to switch from this market to this market. It might be you think, oh, I'm going to start shadow trading or mirror trading Fred instead of Colin, because Colin's not very good, and you move on to Fred, and then Fred starts doing badly and Colin does well. You never know. So,
well, thank you very much. That's very helpful, Gary.
Yeah. So just keep an eye out for, as I say, anyone who's got their own yacht, helicopter, yacht, executive jet, and island as a result out of trading, because they're the ones who really know what they're doing.
Okay. Thank you, Gary.
Yeah. So it's a bit of an evasive one, but it comes down to no one can accurately predict the future. You can have some clues as to what might happen, and you can remove the outliers, but there's no absolute certainty. And that's where, again, as I say, I do a lot of stuff in the insurance sector. Insurance ultimately is a marketplace in predicting the future. And offering a facility for people to hedge against it. And underwriters are very good at working out, what's the risk of something happening, what's the probability, what's the cost, what's the impact, and so on, and saying, well, actually, I'll insure you against that event, which means they're kind of going counter. So whether it's an underwriter, whether it's a quant, it's all the application of mathematics and feeling and direction and that kind of thing. Fascinating stuff.
Yes, it is. I just thought, I can see that somebody has just joined, so maybe I can be a listener now. Thank you so much, Gary. Thank you.
No worries. We'll probably take a different direction. So Ken's joined us, and Ken, I know, is somewhat more on the technical side. How's it going, Ken? Or Ken's just listening.
Hi. No, I just had to unmute myself because I was just listening.
Yeah.
No, it's interesting to listen on other perspective. You're talking about insurance. I mean, with insurance, I think they make most of the money not on prediction, but on not paying out. In other words, legal.
That's kind of not actually necessarily true. It's fascinating, actually, having worked long enough.
They always try to dodge. Come on.
Yeah. So one of the interesting things, I tend to spend my time in commercial insurance rather than consumer insurance. So you've got two worlds in insurance. There's general insurance, which is things like life insurance, car insurance, house insurance, so personal stuff, and then there's commercial stuff. So the companies that I've been involved in do things like insure nuclear power stations, oil tankers, space satellites, as I describe it, things that when they go bang, you see about it in the news type thing. So it's a slightly different market. But what you tend to find, certainly on the commercial side, is that actually insurers are quite happy to pay out because they want to pay out, because that proves that they will and they can, and it builds their credibility. But there's always the thing that the best time to sell insurance on a ship is just after another one's sunk. So it's a weird market,
Yeah,
really.
because you can get a high premium. I definitely disagree with you. I think insurance will pay on commercial when it's low value. A good example is remember the oil spill just off the US coast. Insurance was not going to pay out because what happens is the way they insure it, they have companies after companies after companies, so they can block and say, well, this company's gone bust and that's it. And so there was pressure from the US government, and they went directly to the insurers. In fact, they didn't even do that. They went directly to BP, and they say
Okay.
BP has to pay out, and then BP went and did a deal with insurers. So insurance is one of those areas that I do think, in the end, because it's a profit-making market, in the end, they're very reluctant to honor their side of the bargain. But I'm here for crypto, so
Yeah,
just
the reason we went down the insurance thing is because there's some similarities ultimately about predicting the future. I'm predicting events in the future, that kind of thing, and that's where crypto, share trading, insurance, horse racing, anything really, where you're working out probabilities of events and putting a price on them accordingly is quite similar. And
I mean, that is very true. I mean, the mathematical algorithms that we can produce, because obviously we have great coders in crypto, I think will be a very good positive contribution to the insurance industry. The only difference between the old insurance industry and smart contracts is that the smart contracts are triggered with events, whereas insurance industries have that backing of the lawyer. Like you can go and you can look in between, and that's where we have oracles. And at the moment, you've got Chainlink, which is, I mean, it's a good oracle, but we don't really have decentralized oracles, because I think Chainlink as an oracle is still centralized, because you have to get the data from somewhere at the end of the
you,
day.
you're right. So actually, there's a specialist area of insurance called parametric insurance, which doesn't involve the lawyers. And parametric insurance is really simple. It's if this event happens, we pay this. So as an example, there's parametric insurance now on severe weather. So if the rainfall is more than 20 millimeters in 1 hour, then a claim is paid. That is something that smart contracts now are beginning to be used. So you want to check out this company called EtherRisk, who
Yeah, I've heard of that.
I did some stuff with them a while ago. EtherRisk, one of the originals in this kind of space, where they do parametric insurance facilities on Ethereum. And they do it on, I think it's catastrophe risk and crop protection. Last I heard, they were doing it in Sri Lanka with Aon Insurance. So Aon is one of the world's largest insurance brokers, and they offer what's known as a cat risk policy on crop protection. So if the crop gets damaged, the farmer gets paid, which is brilliant. And they were one of the first as well to do flight delay cover as well. So the whole idea being, if your flight is delayed or it's cancelled, you automatically get paid out. You don't even have to make a claim. But one of the challenges with that, exactly as you say, is you need a trusted data source. So you need what we call, as you say, an oracle. So a trusted data source. A lot of them aren't decentralized. So you think about flight delay. The only places you're going to get credible flight delay information from is the industry itself. There's a couple of sources that produce flight data on, did a flight operate on time? Did it take off and did it land on time? That's quite limited. And so I think Chainlink might have been one of the firms that used to provide that data through it, but there's not that many. And
Yeah, I mean, the thing is, this is like the countries and what you're talking about, like, for example, flight delay. low-hanging fruits because the flights are actually leaving or it's not left on time. But decentralization means the data should be actually put out by not just one or two trusted sources, but by so many different people. So every single
Agreed.
passenger on the flight will say, look, I'm not on the flight because the flight's delayed. Whereas we're getting, as crypto builders, we're getting data sources from centralized entities, which can be corrupted.
Yep.
Somebody can say, okay, the flight's been delayed, yet the flight's left or the flight's gone, and they could, the source could say it's been delayed because it's a centralized entity. And that's where we are at the moment. And
Yeah, you're
data,
absolutely right, Ken. And that's why I've been saying since the early days in blockchain, it was mainly about blockchain 2018 and 19, if you guys remember, yeah? That people used to say, no, we should only bring to blockchain certain type of things. And I'm completely the opposite. No, we have to bring everything to Web3. Everything, because the internet, it was Web 1, was really the centralization of information that was in governments, in libraries, in media, That's what the internet was Web 1, which totally centralization of information and data. Yeah. And Web 2 was the centralization again of that data. So everything needs to come back to, otherwise you cannot trust the sources, like you say, Ken, garbage. You can, what are you going to do? The usual phrase, immutable garbage, because what you're going to do through oracles, doesn't matter how you get the data, it's going to be manipulated. But this is just the beginning, because what people are doing with AI, it's a totally different level, because then you manipulate through the algorithms in AI. Okay? And this is scary. This is more scary than where we are today, and I don't think many people understand the problem yet,
I think extending that kind of goes back to the point before about price predictions and bots and that kind of thing, that if you can work out the behavior of a bot, then you can start spooking it in effect by putting some false prices through. So coming back on Ken's point, I completely agree. My original definition of an oracle was that it was taking in data from multiple sources and cleaning it up and making it available for consumption in a decentralized way. As is often the case in industry, you seem to take descriptions and completely manipulate them. And this is why whenever I hear anything of, oh, we are the oracle for, as in it's in singular, always makes me nervous. So anything where we've only got a single source of the truth, in inverted commas, means it's open to risk and that. And you get things that the example I use is, for example, in Tokyo, they've got an early warning alert for earthquakes. So, if they've got a clear indication there's about to be an earthquake, an alarm goes off across the SMS network and so on. The rail operators shut down or everything like that, which is really, really useful, except that I think it was about 3 years ago, a false signal went out. So the entire Tokyo network shut down. Everyone was expecting an earthquake, and it was a false signal. It's not beyond the realms of possibility if everyone's using trading algorithms to send out a false buy or a false sell signal and spook the market in that way. So I'm quite nervous about all of that.
Because of high frequency trading, and this is not, this is cryptos. It's an absolutely amazing place for the traditional traders who are doing already high frequency trading, because it's just everything is in computers and algorithms. So there's no New York Stock Exchange or London Stock Exchange. There's no traders there. Everything is automated. So all of those guys that are using bots on our space, and they have large amounts of liquidity, you're absolutely right. If anyone wants to be a bad player and still playing legally, because there's someone else actually mixing those signals, then it's a problem. That's why I've been saying for a long time that everything needs to come to Web3 and have those controls, like Ken said, decentralization platforms but still, it's going to be hard because now the AIs are being released, or they claim they are AIs, and that brings a new level of complexity. And I don't think the decentralization of AI is being done properly, because what I see in projects at the moment in Web3, they call themselves decentralized AI, is all bollocks, to be honest, because DAI is a very old concept already. Decentralized AI involves swarm intelligence, pretty much swarms, and if you don't do that, you can never be able to do proper decentralized AI.
Yeah. I think you look back as well, they've had this in traditional markets. So I remember the flash crash of 2010 on the New York Stock Exchange, which was all because of high frequency trading going on, and an event
2008,
happened.
you mean?
No, I think it was I thought it was 2010.
Oh, yeah. 2008 was the financial crisis, and then yes, I remember. Yeah.
Yeah, so 2010 was like the original, or the main flash crash, which was simply all the algos kind of started outdoing each other. So something happened where the price went up or down, and that caused a whole ripple effect. And that can happen in crypto, except that in crypto, what tends to happen is you get illiquidity, whereby no one can buy or sell. So the market kind of seizes. So
But that's good, because crypto is a true capitalism, because if there's no liquidity, it just means nobody wants to buy it. Whereas the 2010 situation you're talking about, remember what happened? They closed the stock exchange.
yeah,
They literally created an artificial scenario. They closed trading, then they reopened only some stocks, not all of them, and they did a gradual reopening. So
yep.
they created an artificial environment. Whereas in crypto, it's
It has happened. No, sorry, Ken. There's big exchanges in the past have paused trading.
no, but they paused it. For example, let's say you pause trading on, I don't know, I'm not going to mention an exchange. I'll just say for a centralized exchange. But you can, in most proper decentralized tokens or whatever coins, you can actually trade them decentralized. So the exchange doesn't really close. The centralized exchange closes because they don't have the liquidity, but the trading can happen. If somebody wants to trade, they can find the trade. Whereas in the stock market, once that happens, there's no trade that can happen. And that's the thing about decentralization. That's so, and that's the thing about Bitcoin. I mean, Bitcoin now is $99 or whatever. Sorry, 99,000.
Don't say that, Ken. You'll suddenly start a run on it.
Tell me what I can buy it, Ken.
But what I'm saying is this: it's a lot of Bitcoin buys and trade. There's no really DeFi element to buy Bitcoin. So the majority, I'd say, everybody, literally, majority of people buying and selling Bitcoin are doing on centralized exchanges. So Bitcoin, I say, is not really true decentralized at the moment, because
Yep.
it's decentralized in terms of the network. So if you want something that's so decentralized, yes, Bitcoin's brilliant. But in terms of trading, because it doesn't have any smart contracts, you have to find a centralized exchange if you want to make a trade. Or, I mean, you can obviously maybe find a friend or something, but there's no liquidity in finding it in friends. You have to go to a centralized exchange, or you might go to a decentralized exchange on one of, I don't know, Ethereum or whatever. But for them to create the wrap Bitcoin, you have a centralized bridge where you have somebody who actually holds the key. So it's not true decentralization. So I think we're really so early. We're going to build more products that can really bring that ethos up.
I think that's a really good point, and it's something, unfortunately, we're going to have to close on as well. I still view crypto currently as a big experiment, and it's an experiment around distributed systems, decentralization of governance, and a whole lot more. And I think you're right that both JT and Ken have mentioned this, that we're not yet at the point where it's decentralized enough whether that's through the exchanges, whether it's through oracles for the data that feeds them and everything. So really good points, really well made, everybody. We're going to have to close off now, I'm afraid. We're on the hour. So Ken, JT, thank you very much for the contribution as always. Annie, thanks for the thought-provoking questions. I hope you got some useful insights out of that. And Hector, sorry we couldn't answer more directly your questions. Come back next week when your microphone's working and we can be a bit more active. So thanks everyone for coming along today. Hope you enjoyed that. See you all next week.
Thank you very much, everyone.
Yeah.